All right. Good evening, everyone. I'm seeing there are still many attendees still streaming in, but it is 8:02, so we will start off tonight's webinar. Okay, a very good evening to our audience today. Thank you very much for spending your evening here with us tonight. My name is Lini, and I'm your host for today on this topic on Ask Me Anything webinar series titled How to Plan Your Finances for a Recession. Very common, huh? We keep hearing this nowadays in the papers, on social media. This word just keep coming to us, right? So you also keep hearing and experiencing even global supply chain issue, high inflationary climate, and you keep hearing terms such as global recession, sell-off, bear market, retrenchment even, right? To your friends, sometimes to your relatives, to your close one and your loved ones. Are you prepared should you encounter loss of job and high inflation? What does it even mean, high inflation? I'm sure everyone tonight has burning questions. I request that you plan your questions because our session must end in 1 hour's time, including Q&A. Okay, for those who are on Zoom, you can see the Q&A box. For those who are on Facebook, yeah, we are live on Zoom and Facebook. Even on Facebook, you can type within the comment. Okay, myself. Also, we have our producer, scriptwriter, Justin, okay, who is also in the background, busy with multiple screens, trying to make this webinar a great one for all of you. All right. Now, before I introduce my guest tonight, I must assure all of you that there shall be no selling during tonight's session, as we really want it to be completely educational for you. So if you're watching us, please share with your other friends whom you think would benefit from this fireside chat. And you can ask all your questions about how do you go about planning your finances if a recession is really coming, right? Live together with our very own financial specialists. Okay, now if we can look at the slide, I'm very honored to introduce 3 of our financial specialists. Let's hear from them how to plan, or how they plan their own finances, or how they help their clients plan their finances for a recession, right? From the left to the right, you can see we have Danny, Financial Services Director. Danny, you can wave to all of us. And then we have William, Financial Services Manager. Hi, William. And of course, Hong Wei, Financial Advisory Consultant. Okay, now let me introduce them a little bit more, okay, one by one, starting with Danny. Danny, veteran, okay, in this financial industry, over 16 years of experience, MBA degree holder, and persevered through all sorts of crises. Okay, 1998 financial crisis, 2000 dot-com bubble burst, 2003 SARS, 2008 global financial crisis, and even today, right? We all sort of passed the COVID-19 crisis, right? Some countries not so lucky, like Singapore, right? So we are still in a way in the COVID crisis. So Danny, why don't you share something more about yourself to the audience?
Okay, hey, hello everyone, welcome, and very good evening to everyone. For each of the crises I experienced, I learned many lessons. So I will be happy to share with you all the experience I have or what I learned throughout all these crises. So for this time, is it any different? I believe there will be opportunities this time. So are you ready to make some money? So let's discuss tonight. All right.
I'm ready to make some money, Danny.
Yes.
Okay, now next on, we have William. Okay, William is a financial services manager of Stewart Investments. He leads a team of 6 financial specialists. They specialize in all sorts of investment solutions that um, they will run through with their clients depending on their objective, their time horizon. In total, they manage an AUM or asset under management of over 48 million. Okay, prior to the joining PhillipCapital, William spent many years, many good years as a senior relationship manager in a bank, and he was award winning during his tenure there, and he continued to be award winning even in his tenure with PhillipCapital. Okay, why don't we hear directly from William to tell us a little bit more about himself? William,
Hi,
over
thanks,
to you.
Lini. Thank you, Lini. Thank you, everybody, for joining us this evening. Hope you can take away a lot of good points here. Take the chance in today's live session with 2 other of my colleagues to ask as many burning questions as you have. As many burning questions you have during the Q&A session. We will do our best to answer as many questions as possible today. Yeah.
All right, great, William. I'm sure everyone's taking notes, right? What to ask, what to ask, right, during the live Q&A session. So, let me introduce my last but not least handsome gentleman tonight. Hong Wei here. Okay. Now, Hong Wei is a financial advisory consultant with us. Specializes again in portfolio management, wealth and investment advisory services. So you sometimes would hear Hong Wei as a frequent speaker on investment outlook, local radio stations, seminars, and so on and so forth. Okay, so I will let Hong Wei introduce himself to you. Over to you, Hong Wei.
Thank you, Lini. Hi, everyone. Welcome to these sessions. I believe investing is a marathon, not a sprint. No matter where you are on this journey, we hope you can find tonight's sessions beneficial and valuable. Looking forward to sharing more with all of you.
All right, thank you very much, Hong Wei. Now, so before we get our panelists to share more, right? I would like you, the audience, to do a little bit of typing, on your phone, on your computer, whichever mode you are dialing in on. Our very first poll, okay, to start off our tonight's session, right? Do you think we are in a recession? Right? Very simple poll. Number 1, yes, we are in a recession. Number 2, no, we are not. And number 3, I am not sure. Right? No answer is right, no answer is wrong. Please, we hope that you can put in your answers, and our Justine will be showing us very soon, okay, on what is the take of the audience tonight. Are you guys the cup is half empty people, or the cup is half full people, or maybe the cup is very full people? I don't know. We will really find out soon. 70. We have 70 people who have keyed in the answer. It's still increasing. Okay. All right. Let me read out. I don't know if I can see. I can see the screen. I don't know if everyone can see. So I will just read out. Okay. The answers from our audience tonight. Are we in a recession? 34% say yes. 44% say no. And 22% say not sure. All right. That is the results we have for the poll number 1 that we have this evening. All right. If I can just bring you next to the first question tonight that we will be asking our panelists. Yes, first one. What is a recession and how does it affect us? Anyone
Sure.
who is very eager to speak, please start off.
Very eager. Let me break the egg here.
You start first, yes.
Okay, so well, very good question, right? According to the poll, so let's go to some data. While most people maintain that it's particularly in US that 2 consecutive quarters of falling real GDP constitutes to a recession. But that is neither the official definition nor the way most economists evaluate the state of the business cycle. Instead, official determination should be based on a holistic look at the data, including, for example, labor market, consumer and business spending. Also things like industrial production and income. Based on this data, it is unlikely that the decline in GDP in the first and second quarter this year can truly indicate a recession. So in US, the unemployment rate is not on the data list, but when considering a recession print, the fact that it has held at a historically low levels at 3.5% in the last 5 months also has bearing on this recession question that you have, and provides yet another indication that the economic expansion is actually still ongoing. So some fun facts to bear in mind. Unemployment peaked at 10% in October 2009. If you still remember, that was in the Lehman Brothers post-2008, 4 months after the official end of the recession, and 7 months after the bear market in stocks hit bottom in March 2009. During the COVID-19 pandemic in the US in early 2020, the unemployment rate peaked at 14.7% in April 2020. The very same month the recession ended, just to give some context. Yeah. What do you think, Hong Wei?
Yeah, I fully agree with what you just shared. Normally, 2 things always happen during recessions. The GDP grows, GDP growth goes down, and unemployment goes up. This is because when economies slow down, businesses take fewer profits. Businesses will cut back by laying off workers. When people have less or no income, we'll spend less money, which reduces the demand. So during a recession, it is common to see business closure, high unemployment rate, and falling housing prices. So we see the US economy decelerate sharply with 2 consecutive quarters of negative GDP growth this year, negative 1.6 and negative 0.9 respectively. It would be strange to declare a recession because the job market is booming and extremely hot. What we need to pay attention is the wage growth rate moving forward. The level which could force the Fed to take even more aggressive actions to slow down the economy and sending us to a recession and have inflation under control. So as Fed Chairman Jay Powell said, the biggest risk to the economy will be persistent inflation, not an economic downturn. So Danny?
Okay, I sort of combine both of you are saying. Yes. I think the important factors when we look at this inflation, I can hear everyone is like GDP, like more than 2 quarters of negative GDP. So GDP is number 1 factor. Number 2 factor is the unemployment rate. Because unemployment rate is very important factor. Why? Because when we are in a recession, we will see more people are getting unemployed. But over now, the unemployment rate are still low. It's very low. It's not high, it's low. So we may not be in a recession if this indicator. The next one is just how Hong Wei mentioned about the contracting measurement of the income and manufacturing numbers. This one also, when recession, the manufacturing numbers will be coming down also. So also the number 4 is the retail sales. When there's a recession, pay cut, or people get retrenchment. So in that case, people will reduce buying something is durable goods. They will stop buying or reduce buying or just reduce spending, everything. So in that way, the retail sales number will also drop. So how does this affect us? So if really there's an recession coming in, you will see manufacturing sector. If you are working in manufacturing sector, you have to start worrying. Why? because your company may start retrenchment exercise. If you're in F&B in Singapore, I think you are quite safe, because F&B, I think now you walk around Singapore, there's always recruiting people. Now there are people saying that just need to work 4 days, right? 4 days, just need to work 4 days. Wonderful. A lot of people say they want to become work in F&B. Okay. If you are in digital marketing, online sales, then you may be slightly worried, because spending less, online spending will be less. That's why you see retrenchment, pay cut, or pay freeze in these sectors. So you may have to start to save more and spend less. Yeah, this is my view. Yeah, back to you, Lily.
All right. Very interesting. It seems like we are seeing signs that it could be a recession, and yet we are seeing signs that it is not exactly a recession yet, right? So let's zoom in further, right? Now we want to, go in a little closer to us, which bring us to our next question for tonight. Justin, if you can flash the next slide, where we focus on Singapore, right? So we grill our panelists a bit deeper now, where they have to focus on us, right? Us, the audience, and me, right? Is Singapore in a recession? So again,
Okay.
anyone?
Okay, I would say no, because as just now we mentioned, because of the Singapore still having GDP number, positive GDP for the past few quarters, and unemployment rate is very low. So I do not think Singapore is in a recession anymore. No. Yeah.
What about Hong
what
Wei
do you
and
see?
Phillip?
Hong Wei.
Do you agree with the majority of the audience, or do you agree with mine? Well, it is not even a very big difference, right? It's quite equal almost, yeah. But of course, the majority still thinks no. But let's hear from Hong Wei and William.
Yeah, sure. I agree. I agree that Singapore economy actually is not in a recession or stagflation. In a recession or stagflation at the moment, and because we see that the economic growth still remain positive, and unemployment rate remain at a very low levels, and expect to stay at these level due to the tight labor market and high level unfilled positions. So, however, we see the globally we are dealing with a very difficult inflation environment. Singapore Central Bank further tightened monetary policy in July to combat inflation pressure. Singapore Prime Minister say the world is not likely to return anytime soon to low inflation levels and interest rate in recent decades. So the global economy is still facing significant uncertainties, which could change the trajectory of Singapore economic growth at any point.
Thanks, Hong Wei. So yeah, sure. So, well, it's awfully confusing. Singapore's economy is not at risk of recession or stagflation at this stage, according to Finance Minister Lawrence Wong. But amid growing concerns about the impact of global monetary policy tightening, especially in places like developed markets like US and UK, to counter surging inflation, Singapore will probably grow 3.8% this year and expand 3% in the next year, according to a Bloomberg survey in early June. In June 2022, the unemployment rates were 2.1% overall, 2.9% for residents, and 3.1% for citizens. So we are at a very, very healthy level, despite all the recessionary fears. Yep.
All right, so there you go. Our panelists agree with the majority of the audience today. We are not exactly in a recession yet, right? Even in the recent National Day speech, right? I think it is also made quite clear that we are not exactly in a recession, not at the moment, right? So let's go on to the next question. This is very interesting. This article in today's paper, Straits Times. If some of you have come across this same article today, where it says Singapore core inflation hits 13-year high of 4.8 in July. Overall inflation reaches 7%, right? Where they further illustrate in the charts, as you can see on the slide, And they also show June versus July year on year on all the different costs, right? Food, electricity and gas, accommodation, services, private transport, retail, and other goods. Okay,
Yeah.
now we will be coming back to this slide, okay, where hopefully one of our panelists will choose to elaborate a bit more, right? They are the specialists for tonight after all. But before that, let's move on to that next slide, which is that word, which Hong Wei mentioned earlier, stagflation. Yeah, stagflation versus inflation. Is there a difference? What is the difference, right, to these two words that again you read or you hear very often? Anyone care to shed some light on the difference between these two big words?
Yeah, so inflations basically means prices just about everything have been rising. So there are two types of inflations. The first one is monetary inflation. When the Federal Reserve print too much money, it reduces the value of money and create an enormous amount of buying power. And the second type of inflation is non-monetary. For example, prices rise because of COVID distortions of the global supply chain. And the geopolitical conflict in Ukraine has caused the prices of oil, gas, as well as other commodities to skyrocket early this year. So, and stagflation basically is defined as a stagnant economy plus inflations. So it's recession and inflations. So indeed, we live in a very strange time. We see the US economy contracted 2 quarters in 2022, but the labor market is remain extremely strong. And we currently also experience a record high inflations. But I think that as long as we feel we can see the economy expansion stall, inflation remain high, and we feel the anxiety of stagflations at this point of time. What do you think, Danny?
Okay, I always like to bring the thing close to home, not using the United States number or something like that. But of course, they are the leaders. We have to look at this. Okay, for the inflation, inflation, like what Hong Wei mentioned, is the price increase a lot in the goods and services getting increased a lot. So for example, I think many people experience this, a cup of kopi at the hawker center. I think during the COVID time, maybe it's like 80 cents, 90 cents per cup. And Zoom this year, because of the gas, oil price go up, the kopi now selling about 110, or maybe some hawker center even selling 120 and 130. The increasing is very fast. So this is the goods inflation. So how about services inflation? Services inflation is like our going for a haircut at barber. I mean, some center you can find $6 haircut. Now is easily $10, like $10. Even the quick cut is from $10 becoming $12 per cut. So this is the services. This is the services. So inflation is always come with high unemployment rate. High unemployment meaning full employment, and also demand and supply is also part of it. So like Hong Wei mentioned, because of the COVID, because of the jam at the port, all this thing, but the demand is still here, but the supply is getting less. That's why this also one of the reason push up the inflation. So then what is the stagflation? So you can see this is the two words, stag and inflation. So stag meaning like the economy is not growing, stagnant. So easy to remember is stagnant economy, but we have a high inflation. So add up, that is the stagflation. So I believe this is easy to understand. Are we in the stagflation yet? No. The answer is still no at the moment, but we need to monitor the numbers, monitor the data in the coming few quarters. Yeah.
Thanks, Danny. Okay, as the saying goes, right? Change is constant. So you can arguably say that we live in very strange times. you also can say that we are kind of in between two economic regimes of high inflation and some form of stagflation. I think the main point here is the line to draw between the two are often quite blurred. Plus, I think we shouldn't be just drawing two extreme polarities when really defining these two economic regimes and where we are. So, of course, back to definition, stagflation is an economic environment characterized by high inflation, high unemployment, or slow or negative economic growth. In other words, not fun at all. While inflation is not an environment, but more of a causation and effect spurred by three main things: a demand pull, cost push, or built-in. In our current environment right now, it's a combination of these two factors. Okay, so just to elaborate, so demand pull comes from overwhelming services industry, i.e. tourism and hospitality. Cost push stems from supply chain woes reeling from COVID-19 pandemic disruptions in trade, i.e. for example, the dynamic zero COVID in China. And then, of course, lastly, building factors from which inflation spiral, where expectations of inflation trickles into corporates and individuals, that it will last, therefore leading to persistent hikes in wages and cost of materials to hedge future inflationary pressures. So it could be a self-feeding vicious cycle. So where are we now? Justin, could trouble you to go to the previous slide where we have the data? Yeah. So just to take note of this, the last print in US for inflation for the month of July, which came out in the 10th of August, was standing at 8.5%. Back in the June reading that came out in the first week of July, that was a shocker, right? That was in US, it came at 9.1%. So, and the funniest part is yet unemployment came down from 3.6% to 3.5% in US from June to July, which defines a very tight labor market. But yet we have two negative quarters of GDP growth. So technically you have some form of inflation picking over, like oil, but yet with more expected slowing of growth on the GDP front, coupled with a very tight labor market. So effectively, the Feds or the Federal Reserve is walking a very fine line of engineering a soft landing. So to draw context again, you can look at the Business Times, the chart. You can see very common similarities, right? So consumer price index, like what I mentioned in US, is right now at 8.5. We are having it at 7% for the month for the reading in July. So pretty much what's happening globally in a very globalized world, I can't say that we can stay away from what's effectively happening to our big counterparts in the developed markets. And you can see on the right the price rise by category. I think the main thing why sentiments are in the toilet right now is quite straightforward. You can see, right, private transport and basically electricity and gas takes the blunt of, in fact, the highest year-on-year increase and basically contributed to the most when it comes to the consumer price index. It's also a function of effectively what has happened in the Ukrainian front. Yeah, just to give some context in our numbers versus the global markets. Yep.
Great. Thank you very much, my three panelists. I mean, indeed, right? I mean, we can all feel very, very obviously, like Danny mentioned, your kopi price, and then of course you can feel it like daily, right? Your haircut, your as you used to be, how much when you top up your full tank, and how much is it today? So electricity, same, the neighbors will be saying, hey, how much are your electricity? I will go up a lot, no? So I think all of us are feeling it. The bus rides, the MRT rides, some friends will be telling me, hey, normally transit, change bus, not so much. I think increase already, So all of us are feeling this, right? So let's move on. We are about halfway mark here. Now, this part, right? This slide here, where really what Danny, William, and Hong Wei is best at, right? They do this day in, day out. I want them to share their secrets, right? How do you plan your clients' finances differently in today's market? This is very interesting, and I'm very curious what answers you guys have.
Okay, Lini. I would say secret with the open at the front, open secret. Okay, so well, as much as we right now know that we're in quite a contradictory economic regime, we are sticking to our guns on a few key fundamentals that we feel will always remain evergreen regardless of the various market regimes that we will be in and will be in the future. First and foremost, we encourage our clients to keep a minimum 6 months worth of income as a guideline as the emergency funds. Keep in mind that an emergency fund refers to cash and cash equivalents. Secondly, sticking to your financial plan and having one in the first place. Bear market is a perfect time to revisit your financial plan. Not forgetting, after all, $1 invested during a bear market tends to go a lot further and stretches your dollar. Last but not least, things you can control. For example, increasing your savings rate. By cutting back on spending and increasing your savings rate, you can add a lot more flexibility to your financial plan and could even free up more buying power to put to work when equity values are relatively low, as we have seen in the June lows of this year. Yep. Yeah. Pass the baton on to Hong Wei. Yeah.
Hong Wei, you need to unmute yourself.
Thank you. Thank you, William. So I think the very critical point is to deleverage and increase your cash reserve before a downturn. So the key to survive is don't run out of money and make sure you have sufficient emergency fund to weather through, like William had just said, these emergency fund to weather through the risk of low or no income period. Individual with high levels of debt are especially vulnerable during a recessions. So the more debt you have, the more cash you need to serve your debt payment, and you need to reduce the debt level before it is clear the economy is down. So this is crucial, especially for retirees. It is extremely painful to take withdrawal from your core investment portfolio or cutting down your net stack when market is at the bottom. So we have to prepare for the winter. We know that winter always comes, right?
Okay. For me, I would suggest you go back to the goal setting. So what is at the beginning when you do investment? So is it now is it changed to short term or medium term or long term? If you are in the short term now, you decided to do investment, it's a short term, then I suggest maybe majority of your investment should be in the low risk guarantee type of the instrument too. If you have a mid to long term, say 5 or 10 or even longer, I think there is no need to worry, and probably now is the best opportunity to average in. Yeah, this is my view, and this is when I'm talking to my customer as well. Yeah.
Okay. It looks like I was vigorously taking notes. I don't know about the audience. I pick up a few things here. Williams emphasized, the importance of having like your 6 months worth of your income, right? Which is repeated again by Hong Wei on having a cash reserve, right? And of course, William and Danny both also advise that it is worthwhile to revisit your finances, right? Is there any change? Has your time horizon changed? Has it become shorter, right? If so, then perhaps certain things need to be readjusted, right? To prepare should there be a recession, right? Then of course, Hong Wei also made a very, very important point about debt, right? Don't go into debts that you are going to have difficulty in paying in the future, right? So a few things to watch out there. And Oh, I think our panelists need to drink a bit of water before they speak in another language. Is it? No lah. Just let's take turn. For our audience again to give their take. Okay. So brings us to poll number 2. Okay. Now, do you think that now is a good time for investing? Okay. Again, the first option is a yes. The second option is a no, and the third option is not sure. Okay, those who are on the Facebook, you can also comment on the comment box. Okay, we give it a little more time for everyone to give their opinion on the matter. This one not 50-50. I'm seeing very strong answer in one of the options. Okay, give it a few more seconds and then we'll go to the we'll announce the results. Okay. All right. I think we are more or less done. Almost all of you I see have given your answers. Thank you for your participation. I think make it more fun, right? It wouldn't be just one-sided, but it is we get to hear the spectrum from our audience as well. So we see very strong yes, it is a good time for investing. 60% say yes. And then we have 20% who say no, and another 20 who say not sure. All right. So time to go back to our panelists again, where we will ask the next question. Right? Maybe to those who say not sure, right? Maybe you guys can help. How do I know that my portfolio is well positioned for a recession? Anyone who would like to start?
Okay, maybe I start this question first.
Danny,
Okay, so we are talking about the portfolio. So you see, if there is really a recession, economic will slow down. So the earnings will drop. Therefore, the cash flow of a company become very important. So you need to select those companies that have sustainable business model. Example like Microsoft, Apple, Amazon. So because they have a sustainable business, because they are in cloud computing or something like that, you need to use it every day. And they are also cash rich and also net cash companies. So you need to search for this company. So you go back to your portfolio again, go to the company financial report again, and then maybe you need to cut or switch some of your holding. So over here, if you are not familiar with your financial report, and also you doesn't quite understand the ratio after you see the report, then maybe you need to consult your financial expertise or financial specialist. If you do not have one now, maybe you have to search for get someone to help you on this one. Yeah, for the portfolio. Yeah.
Okay, thanks, Danny.
Yeah.
So maybe just want to add my point of view. I think it's very important to get some very important data and information in. One of the main key thing when we manage portfolio, right? The key determinant driving your returns in a portfolio, and also its volatility. When I mean volatility, defined by the drawdowns, like for example, this year the Standard & Poor's 500 had a peak to trough of about 24% in June. So most of this all comes down to your portfolio asset allocation, which is basically the mix between your equities, your bonds, and your cash. So one of the biggest mistakes that most investors make is setting up the wrong allocation or mismanaging their position weightings. Okay, so mismanaging allocation and weightings can lead to accidentally very big amplified losses. So taking periodic rebalancing of your original position weightings will have you essentially buying low, selling high. So you can take advantage of cheaper equity valuations and within your own portfolio holdings. If you're new to investments or has stashed aside some reserves, now is a great time. But of course, for the fear of the unknown, right? Because nothing is ever certain in the markets, you can always adopt dollar cost averaging into some of these equity positions. In fact, the only times when dollar cost averaging tends to beat a lump sum investing is during a market crash scenario, or typically during a bear market. Yeah.
Yes,
Hong Wei,
I
what
think
is your opinion on this?
thank you, Lini. I think that what Danny touched is at this point of time, you want to invest, is very critical to select. If you want to select individual stock, is look at the specific company, is like quality stock. We're not talking about valuable anymore. We need to have a quality stock at this point, and diversify your portfolio. So by diversified portfolio, you can do, that's important to diversify across different asset classes, countries, currencies, and even time. So international exposure is also important. I know that many our local investor default 100% to a domestic asset. And you need to diversify so your risks are not concentrated in just one area. And you must have the ability to have a focus on the long-term investment horizon as opposed to a shorter term. After going through multiple downturns, I have learned that maintaining these diversified portfolio is very critical. This will help us to minimize the risk and maximize our return in the long run and weather through the downtime as well. Thank you.
Thank you. So, so cash flow, it looks like if you guys, the audience is someone who well, pick your own stock and trade your own stocks, right? Then the tips our specialists have today is make sure you are choosing company with strong cash flow, right? If I'm getting Danny correct, meaning they have to be sustainable, right? Be able to also weather through this current market at the moment, right? Which is also repeated again by Hong Wei, where you are not just looking for quality. You're looking for quality, but not and not just valuable stocks, right?
Yes.
And Hong Wei also mentioned the very important point on diversifying, right? Then that leads to William, who feel that the allocation between equities, bonds, or cash is very, very important, right? Bonds would be all those fixed income solutions, right? Dollar cost averaging, right? Again, something that you hear quite often, or sometimes people call it regular savings plan, right? It can be regular savings into stocks. It could be regular savings into a certain fund, right? But taking that dollar cost averaging opportunity there, right? Which is even more important in a bear market scenario. All right, I would then trouble Justin to bring us to the next slide. This one also very important. I'm also very anxious to know the answer. What is the telltale sign that my investment is too risky? Anyone to start off? Telltale sign.
I can. Okay, let me start again. Okay. For me, it's quite simple. If you feel, I know some of my customers also like that. If they cannot sleep well, they told me, oh, I cannot sleep well. Equity markets is falling. So I believe that is because they are heavily overweight in equities, not diversified enough. And of course, a lot of people always say this, I'm a risk taker, I can stomach the risk. But in fact, when the market collapse or market turn the other sideway, they will panic or they cannot sleep. So in fact, then you understand yourself, actually you are a low or moderate risk person. You can't take on high risk. So I would suggest you go back to the risk profiling to re-evaluate your own risk profile and understand yourself properly. So if you are a moderate risk person, admit that you are the moderate risk person. So don't over commit in equity or something like this one. So I think that would be, you can sleep well after this. Yeah, okay.
Hong Wei or Phillip,
Hong Wei,
any
yeah.
different take? Yeah. Can you sleep well yesterday?
So the market definitely is really, really volatile and bumpy and choppy since early this year. So two things I think you can watch out is, firstly, if you are invest into the market and hope it will rally in a year or two so that you can make a significant profit to fund your major purchase or to fund your kids' educations. I think 1 to 2 years time horizon is just too short and too risky. Second sign is that you have a high level of debt with very little cash reserve, and this makes you very vulnerable during recessions. So we have to prepare for the winter. So remember to look at the debt and your cash reserve before even start investing.
Thanks, Hong Wei. So it's vital to understand that some investments may have dramatic fluctuations in value, but of course carries a very high potential for larger gains, while others may be more stable with potentially much lesser returns. So if you find yourself checking on your portfolio value in the middle of the night, or I think some people do it hourly during the day, perhaps it's time to dial down on your equity allocation. So it's back to the previous slide where I mentioned on your asset allocation, which is the percentage of your equities within the entire portfolio mix of the bonds and cash or cash equivalents. So it all comes back down to your financial plan, how your investment portfolio fits into this plan. If you actually have, number one, an emergency fund, number two, a reasonable time horizon, I don't want to say long, right? It's very subjective. And then coupled with sufficient diversification, your portfolio will not be waking you in the middle of the night. Yeah.
Okay, so wow. So if you are checking your, logging on to your latest statement at 2 hours, every 2 hours or every 1 hour, and then after that resulting in sleepless night, right? So maybe it's time to relook. Indeed, it's not easy, right? I think, which is exactly why you should seek the help, of a trusted financial specialist if you think, doing it yourself is just too challenging, you don't have the time, do consider having financial specialist. It's like a doctor, your finances doctor, right? To have a checkup, right? Because sometimes is this, I'm not sure, and why not, look for someone who is doing this day in, day out. Yeah. So high or low risk, sometimes you like what Danny say, hey, I okay lah, I can take all this fluctuation up and down, but actually a bit of fluctuation you already cannot sleep, right? So while you may say that you can take the fluctuation, but in the end, from your reactions, you should, like Danny say, admit if you are not a risk taker, it's okay, right? There are always solutions that could be more suited for you, rather than having sleepless nights, right? So it depends on your time horizon, whether your debt and your reserve, is in a good balance, right? And again, the right allocation. Too much equity, too little equity, too much bonds, too little bond, right? So there you go. Telltale signs. I hope that gives you some tips on what to look out for, right, in your own finances. Now let's go on to the next slide. What do we have, Justin? Okay, this is the, sometimes as much as we want to, we really hope to answer as many of your questions as possible, but with the time limitation, you may want to connect with any of our specialists tonight. You can either scan the QR code, or maybe the easiest is just take a picture. Anyway, this is on Facebook Live, so we will leave the entire recording of the session on our Phillip Wealth Advisory Facebook, which we will share later if you would like to scan the QR code. And of course, in that Facebook, we will be always telling you guys what is our next Ask Me Anything webinar, right? So here you can directly chat with any of them, any one of them, or you can also scan our Facebook page here, Phillip Wealth Advisory. This is where we will share, when is our next webinar, what is the topic about, and many other useful information as well on this Facebook. I think most importantly, you would like to be notified, right? Whenever we have such a topic. We also want to hear from you. What are the burning topics that you wish, you can find answers from, right? And we'll find you the right specialists, the right experts to that subject matter. So do follow us on our Facebook page. And let's see, what do we have? Q&A session. Okay. Wow. Let me see. Someone by the name of Kate Hua. Okay, the very first question. Anyone can answer, okay?
Yeah,
This
sure.
question is, what is
Sure.
technical recession?
Okay,
What-
so Kate, back to right from the start, technical recession is defined by two consecutive negative print. So effectively, the US is in a technical recession already, albeit when it comes to that, that's a good question, right? So like what I say, it's a choice of words. The reason why most mainstream media in US don't go around saying, okay, we're officially in a recession, because technical recession is, like what I mentioned, a negative print, but a official recession looks at a lot more different key determinants, like things like consumer spending, manufacturing, incomes. So obviously, when you consider things like incomes, there's a very strong tight labor market right now. I can't really remember the exact numbers, about what, 10.5, 10.6 million jobs for you're talking about what, 7 to 6 million people who are actively looking for jobs out there. So it is a very tight labor market, right? And even what's Wall Street basically pricing in is the fact that some elements of what we call soft landing could be achieved if the corporates going into third and fourth quarter would hang on to what I would say a very tight labor market, where they hang on to their employees and really I would say refrain from mass retrenchment. Yeah, so we have to take into aspect when we define what's a technical recession, but we're all here mainly as investors. We have to take in mind how much of that is also priced in. Yeah, any Hong Wei, Danny, any one of you want to add in?
I think it's quite technical. It's what you already mentioned. So yeah, we can jump to the next question because we have time limit.
Yeah, we have a lot of questions.
Yeah.
We try to answer as many of your questions. I think Jaslyn, when you ask, should we stop investing in equities, bonds, and fixed deposits? I think that has been answered, right? Because there's no one solution for all, right? So again, we have to look at your time horizon, your objectives, before we can give you a straight off answer, right? Now this one a little bit more detailed, anonymous. Besides investing in equities, what do you think of SSBs? Right, a lot of Singaporeans wonder, is this good, right? Would the interest return grow higher by year end, or could it even be higher next year? If the allocation is only 9,000 currently, should one then invest over a number of months from year end onwards? Anyone?
Okay, so we covered this within the team, I think mainly because, like what I mentioned, when you invest in a portfolio, we don't just abstractly look at, okay, that's equities where we want the highest return based on real returns after inflation. We also have to look at things like SSB, we have to look at money markets, we have to look at short duration bonds, mid duration bonds, inflation bonds. So to answer your question specifically, you're right. I think, let's put it this way, just 9 months ago, before inflation has went up so high, SSB clearly was not attractive at all, including all or any most FDs. But today you go to even right now, I think the 10-year is yielding at about an average of 2.8%. If you stretch out for the full 10 years. Good question. Would it go up? I think that's that regime is very difficult. I think it's pivotal on a couple of things. If inflation do pick over and the Feds can give a guidance that they kind of engineered some form of soft landing or some control over inflation, then potentially most government central banks, including, of course, MAS don't do central bank intervention. They kind of just, well, I'll say manipulate in certain ways. But then you might have then, of course, if inflation picked off, you'll probably see a correlation with some of these interest rates picking off also. So I think to answer your question, since the allotment is 9K and it's overwhelming, obviously, because at the yield at 3%, I would say go back to your main allocation, figure out how much is your total portfolio. I give you an example. If, let's say, i.e., someone has 100K as a total portfolio asset allocation, you do a risk profile, or just based on really doing certain litmus testing, like how long is your financial plan, how long do you need this sum of money depending on your age. Let's say generically, you come down to an equity to bonds cash allocation of, let's say, 60-40. We typically call in our finance line a typical 60-40 rule, right? So for what we call a moderate approach, what essentially happens here is then 40% of your bonds, subset of that 40% can clearly go to an SSB. You can look at it as a subset of short duration bonds or even money market instrument in this case. Good question. Can, of course, you stretch this into your emergency funds? Ideally, try not to, because it should be money that you can often use. But take note, most people also are not aware. Doesn't mean you lock in your money for 10 years. It's going to be stashed away. What it means is if in the middle of this duration of 10 years that your money is locked in an SSB, you can withdraw earlier, but subject to a proration of the interest. So for example, if you do a 1 year, technically your average return will be only 2.63, but it's not shabby at all. So yeah, so I hope I answered your question in the element of looking from a macro perspective of your entire portfolio, and then you can then figure out which part of that cash or short duration or bonds can actually fit into a SSB. Yeah.
Yeah, so I think I agree with that. I think it's important come to the full overview of your asset, an overview of the asset, and how do you allocate it and diversify it across different asset classes. I think that is important to have that overview, then decide how much you would like to allocate, or how many percent you would like to allocate in equity, in bond, cash, properties, even gold or your Bitcoin. So there are so many types of assets to diversify out there. As opposed to the questions that I'm interested to elaborate a little bit more about the interest rate. The interest rate, would it grow higher by year end? So we can see that the market, we have to correlate it a lot with US, because US market is still predominantly influence the global market as well. So we can see that the market expect the Fed to raise interest rate less this year after inflation has peaked, and start to pivot and beginning to cut the rate next year. So what happens, and we see last week after the Fed announcement, and we can see that Fed remains very hawkish, and it seems like the rate hike may continue further into 2023. So Fed would like to see that inflation coming down further, maybe not to 2% target, because we still remain way above this target. And then if we want to get to 2%, maybe we get into really like a recessions. So everyone is looking for soft landing, but we're not sure we will get there. But of course, I believe that the rate hike will continue. Maybe we can see a 50 or 75 basis point again raise in September, and to combat these inflations, because Singapore Central Bank also continue and follow the steps raising the interest rate to combat these difficult environment, to make sure that the inflation is under control. Yeah.
Okay, thank you, Hong Wei. I think I will take one or two last question. Okay, I see a lot of you are asking very specific like stock tips. I don't think we are going to go in too much on that, right? I think this today's session is more about financial planning and things like that. I think for stock pick we'll leave it for maybe other seminars and webinars within our Poems website. There are really a lot that really covers on very specific stocks. I would like to take this question by SK Talk. Okay, with maybe Danny, Danny, you can take this question. With high inflation already kicking in, right? How should we adjust our investment portfolio, especially for those in their 40s to early 50s who are already planning for their retirement, right? And what is your comment? What is your suggestion? In fact, SK Talk would really like to hear directly from Danny on his take on this.
Okay. Okay. If this person is already entered 40s to 50s, so first we look at the horizon. His retirement, let's say we set at 65 years old. So he still have about 15 to 20 years to go, or maybe 10 to 20 years to go. So we still have chance to, the portfolio still can have a higher risk or medium risk. So back to just now, William Hong Wei mentioned, it's still down to the asset allocation. So probably now inflation kicks in. So in your portfolio, if you are in the unit trust or even stocks, you have to convert them to quality stocks, or look for those quality unit trusts which invest in quality company. Why? Because some company may go bust during the recession if their business is not good, if they're in high debts. So at least when you are in this recession, they are able to weather over this period, and then your portfolio will do better. Of course, in the asset allocation, you also should put something because you're going to plan your retirement. So maybe you also need to look for some retirement plans like guarantee capitals in 10 to 20 years time. So supplement your CPF life. You also need to look at the CPF life. After calculate that, then you have some guaranteed retirement plan for defense. Then you come to this investment. Yeah. So with this, I believe you can sleep well, because you know that when you retire, you have CPF life, you have guarantee plans, then you have some bonus from the unguaranteed but potentially high returns. So with these three, I believe you can sleep well, and you certainly guarantee that you will have some big lump sum of guaranteed return when you retire. Yeah. Okay.
Thank you, Danny. So I think we can quite safely conclude, right? I mean, at least for the topic of tonight, what we are trying to stress here is the right allocation, yeah, in equities, in fixed income or bonds, and in cash, right? To have very correct formula that is suited for you, right, as an individual. Now, sorry, I won't be taking any more questions. It's now 9:05. I want to bring you guys to the last section for tonight, okay, which is key takeaways from each of our financial specialists on the topic for tonight, right? Let's roll. Who is going to start first?
Yeah.
Okay.
So,
Hong Wei, yeah,
right,
you go first.
Hong Wei, you go first then.
Okay, sure. So I hope you guys find these sessions beneficial. So two key takeaway, I would think before the recession hit us, I think first saving is more important than investing. So we cannot control what the Fed is going to do, and we cannot control when the market will go into a recession. And what we can control is our saving rate. So if we have a good saving, it serves as good cushions or safety net when winter comes. And of course, diversify. Diversification is the best tool. This will not only to reduce your risk and also create a room to maximize your return in the long run. Thank you.
Thank you very much, Hong Wei. I think that's a very good summary for the audience tonight. Let's hear more from either Danny or William, whether there's more tips and advice for our audience tonight.
Okay, I would say do not panic or despair. Just go back, revisit, and stick to your original goals. And remember, defense is important. Defense and attack in the ball games. So try to get a good defense first, then maybe you go all up to attack. Yeah, so what is the defense is just now what I mentioned is like some guarantee, Singapore savings bond, something like that. When your foundation is strong and you can start doing some attack. Yeah, William, back to you.
Yeah, sure. Okay, so today's whole thing all surrounds around recessions, right? So recessions are notoriously difficult to predict. So avoiding mistakes in your portfolio and finances will really go a long way in your investing journey. So remember to rebalance your portfolio holdings, even if the markets feel like it will keep going up. So you're keeping the risk in your portfolio well checked. And always remember, do not over-concentrate on any one holdings, no matter how strong your narrative may be. As the saying goes, he who lives by the sword dies by the sword. Yeah.
Okay, I think that's really insightful sharing tonight from all our specialists. Don't worry if we don't have the chance to answer all your questions. Feel free to get in touch with any of them. Some of them even have like a broadcast, with their customers or prospects, where they share important sharing that they feel is useful for your planning of your finances, right? Otherwise, if you feel more comfortable to just talk to Phillip directly, feel free to do so. Our email, our phone number is there as well. Okay. We apologize for the slight overrun, 9:09. And once again, thank you to the audience. Thank you to my panelists for your time. I hope
Thank you.
you had your dinner before you came on
Thanks,
board.
Lini. Yes.
Okay,
Thanks.
and thank you, Justin,
Thank you,
too, for
everyone.
working very hard behind the scenes.
Yep. Thank you, everybody.
Bye.
Thank you, everybody. Good
See you
night.
next
Good night.
time.